Okay, this is a continuation of safe places for money or cash equivalents. I want to direct you first of all to this table right here that I put together. It's just the three different bank products: savings, money market accounts, and CDs. Again, a 1-year CD is what I'm going to be looking at. The next are the government products: the T-bill, the EE savings bond, and the I savings bond. And then the last one is a money market mutual fund. I did not talk about the T-bill in the last video, but I'll introduce it now. So I'm going to be typing in rates here, and we're going to determine as a class where the best place is to hold our emergency fund or our safe money. Again, that money that we need to cover things that happen in our life that are unexpected and come up, because I think everybody has that happen. So first of all, what I'm going to do is I'm going to go over here and I'm going to split my screen. So I'm going to reduce it, and then I'm going to take my Excel spreadsheet and I'm going to run it into the side over here, just drag it so it goes exactly on half my screen size. And then over here, I did the same thing with a web browser, so I can have these two screens active. So I'm going to be looking up rates over here and then filling in this table. So there's a site that I use frequently. It's called bankrate.com. It's a site that just has it's a sweep of all bank rates out there. So I'm going to go to Bankrate right here, and I'm interested in savings rates. So I'm going to click on this savings rate tab, and I'm going to go over here to savings and money market, because we're trying to find out where we should hold our money. So here it's updated for June, and we can start scrolling down here. I'm going to click on this APY right here, and I'm going to do it the other way. I've sorted this from the lowest rates to the highest. So if I'm looking at these lowest rates right now, I can see that there's Chase. So the rate on a savings account at Chase Bank is 0.01%. And there's a minimum balance requirement of $25. So if you go below $25 at Chase, I'm sure they're going to charge you. Okay, here's Wells Fargo. There it is, 0.01%. Let's look for our other popular bank. There's Bank of America, savings 0.03%. So just to give you some perspective on this, I'm going to go over to this chart. I'm looking for the annual percentage rate, and I'm going to put in here for savings that, just like what it said, is 0.1. Oops, that's not even enough zeros. 0.01% at Wells Fargo. And if you look down here, I've made a calculation here that says if I had $1,000 in my Wells Fargo account, I'm using just annual compounding. If I had $1,000 in Wells Fargo at 0.01%, I would have earned right here 1 dime in the year. Remember the dime? 10 cents. That's all I would earn in a year on my money at Wells Fargo. All right. There's US Bank, by the way. It's 0.04. And it's going to show, let's see if we can find any other popular banks that we might have. There's US Bank. There's Money Market. Okay, so now we're getting a little bit higher. Remember, I told you those rates in money markets are going to be slightly higher because there's more restrictions. Okay, but so right now I do know that Golden One is 0.15%. So there's your 1.5% at Golden One, which means in a year you would earn $1.50. Okay, $1.50 at Golden One. Well, hey, it's more than Wells Fargo. Okay, now I'm going to go back over here to bank rate, and I'm going to resort these. So I'm going to do this. So now they're sorted by the highest interest rate. And what we see at the top here is this bank called North Point, and its interest rate is 2%. 2%. 200 times Wells Fargo. But there's this awful minimum balance of $25,000, and that's just way too restrictive. However, we can scroll down and we can see that there are a lot of other banks that offer significantly higher rates. But what you should notice about these banks is that they don't have a presence in the grocery store. They are not on every corner. I'm going to stop right here at this bank called Synchrony because I have had several students in the past who use this as their savings account. It pays 1.75%. It does not have any restrictions, so there's no minimum fee. It's just a typical savings account. Synchrony is a virtual bank, which means that all your banking is done online. I don't even know where Synchrony Bank is located. It's somewhere, but it's a virtual bank. So again, the model might be that you have a local checking account like I do. I have a local checking account at Schools Financial Credit Union. And then I push all my savings out to a virtual bank. I use Ally Bank, but Synchrony is another popular one with students because the rate is actually slightly higher than Ally Bank. So if I go here, 1.75%, because that's what it is, I see now that in a virtual bank, I could earn $17.50 a year. So just by giving up the savings account, let's say you had Wells Fargo, keep your Wells Fargo checking, but then transfer all your savings to your virtual bank. You can earn significantly more interest. So who are you? Are you a Wells Fargo person who wants to earn 10%? Are you a Bank of America person who wants to earn 30 cents? Golden One at $1.50, or a virtual bank at $17.50? And remember, keeping this in there, it's going to compound. And also, I want to say that most people don't do virtual banking because they don't know about it. And now you do. So you can look at bankrate.com and check out all these different rates and what they have to offer. I think there's lots of opportunities to make more money. I'm going to go back over here because we have money market accounts, and I think the money market account at Wells Fargo is 0.3. So there's 30 cents, and it has even more restrictions. I can't remember what Golden One is, but let's say it's point 0.3. I'll be generous. So that will give you then $3. And then a virtual bank is going to be about the same. It's still going to be 1.75% because there's really no difference between a money market and a savings account at a virtual bank. The rates are still going to be significantly higher than anything at a local bank. And again, don't forget that model. One model is to keep your local checking. So when I receive my paycheck, for example, it goes into my local checking account at schools, and then I just take my savings account portion that I put in my emergency fund. I go on my phone. I have the app because all of these have an app, and I click on my app that says transfer my money directly from my checking account to my virtual savings. And then when I need my virtual savings, I do the same thing in reverse. I tap on the app on my phone and I bring it back. Now, one of the questions that always comes up is, well, it's not safe to have online banking. And I think about that and I think, but my school's account is also online and I have my school's app on my phone too. So what's the difference? I don't know. Everything is online now, so is really a virtual bank less safe than your local bank? Anyway, moving on. So that's a simple fix. Open up an online virtual bank for your savings and start making more money. Okay, the next one are CDs, and I bet you can expect, I'm going to go back up here at the top, and I'm going to look at, actually I'm going to have to go back to CD rates. So I'm just going to go back into bank rate. I'm going to click on CD rates right here. Now CDs, remember these are the most restrictive. So I'm going to go here and I would expect to see higher rates, but again, I only want a 1-year term. So I'm going to click on a 1-year term right here, and I'm again going to sort at the bottom. So I want to see what's happening if you're, okay, so Chase, here we go, all 1 year. Chase Bank, 0.01, the same as a savings account. That's all they're going to give for a $1,000 deposit on a CD. Bank of America, 0.05%. Wells Fargo, 0.10. Okay. 0.10. So on my $2,500 minimum balance at Wells Fargo, they're going to pay me 0.10. So again, on $1,000, that's $1 to hold my money for 1 year. I really want you to think about this. I'll pop out to Golden One in a minute because I don't think it's on here. But now I'm going to go back up to the top and resort these so I pick up the virtual banks. So here they are. If you put your money in a virtual bank CD for 1 year, it's going to pay you these types of rates that I'm going through right now. So here's you could put in any amount over $0, lock it up for 1 year. I'm just going to put 2.3. Okay? So on a virtual bank, on $1,000, you're going to earn 23 versus $1 at one of our domestic or one of our local banks. So now you know. That's the banking system here. I'm curious, I'm going to go to Golden One since it's very popular. So when I go to Golden One right here, I want to see what their CD rates are. So here's regular term certificates. I want a 1 year. So it's going to be right here, 0.35%. So it's slightly higher than a money market account, which we would expect. And I'm going to stop this right now. Sorry for that interruption. Someone knocked at my front door and my dogs just went crazy. So let me put this spreadsheet back up and let me go back to where we were. Okay, so now we have these different rates for our bank products. And now I'm going to move over to government products. And right up here in the recording space, remember I was at bankrate.com for the banking information. I popped into Golden One, and now I'm going to go to a different site, which is called Treasurydirect.gov, and I've also put these on this form. So Treasurydirect.gov is going to have a lot of the information, or all of the information that we need for our government products. So now we're over here on government products. The first thing when you get to treasurydirect.gov, so let me, when you go in here, so you're going to have to do some exploring for homework this week. You're going to get to this website. This is the main hub for all government bonds, so it's a good website to know. You're going to be under individuals because that's what we are. We're individuals. And we can look at right here T-bills, notes, bonds. We're going to learn more about these next week. But if we go into Treasury bills, a T-bill is a product you can buy from the federal government. It says right here, maturing within a few weeks or within one year. So it's a very short term purchase to get a little interest rate boost from the government. So, in order to find the current rates, they're sold at auction. I'm not going to go into all the details because I'm not sure if it matters. If you want to buy T-bills and the interest rate is attractive to you, then you can set up an account and buy them. So, currently, the rate on T-bills, so we're going to be looking at bills right here, which are not notes or bonds. Well, tips or something else. Okay, I'm back again. I just had to look at this because the rates on these T-bills has jumped so much since where interest rates have been ticking up. So anyway, for a 52-week, 1-year T-bill, the interest rate is going to be 2.275%, somewhere between 2 and 3%. So we'll go and put that here for a T-bill from Treasury Direct. So about 2.3%. The difference, so that's about the same as a CD from a bank. The T-bill is also guaranteed by the federal government. This one has a maturity of 1 year, so you will earn that amount of interest over 1 year when you purchase a T-bill. I'm going to have you look up more of the information in homework this week, which you can find. Another interesting fact about a T-bill is that it's tax-free from state taxes. One limitation of a T-bill is, again, that weight. It's not quite as liquid as a savings or a money market account because you have to wait till it matures. And in this case, the maturity was 52 weeks or 1 year. Okay, I'm going to go back over here. I'm going to go back to the home page. And now I'm going to show you, again under individuals, here's EE savings bonds. Okay, EE savings bonds. Want you to read through this information, how they work. The current rate for savings bonds is 0.10%. So again, that's only $1. Interest rates are very low. They have a fixed rate of interest for up to 30 years. Can't imagine why you'd want to lock up your money at 0.10 for 30 years. You have to wait a year before you can redeem them, so their liquidity is not as convenient, but they are risk-free because the government always pays their bills, despite being grossly in debt, but that's for another day. Okay, and then the last one that we want to talk about that's a government product is the inflation adjusted savings bond. So again, that's here, the I savings bond. I savings bond, I asked you a question how it differs from the Series EE savings bond. And when you go in here and click on the I savings bond, it says comparing I bonds to EE bonds. So I want you to do some research yourself. I want you to know how I bond interest is calculated. It's a fixed interest rate plus a inflation adjustment. So that if inflation goes up, again, the amount of return on your I bond is going to go up. So again, you can't redeem those for until after 1 year, and there are some restrictions. But this is where you would go to find Series I bonds, and I think it had on here, if we current rates on our I bonds. If I click on here, how does it earn interest? I think it says Here we are. This is an example. So the fixed rate right now is 0.3%, that component, and the inflation rate is semi-annual inflation rate. So the composite rate, that's semi-annual, so we'd multiply that times 2 for an annual rate, is 2.52 for the I bond, which again is comparable to a T-bill, significantly higher than a traditional savings bond. And again, all the information is going to be on treasurydirect.gov. Okay, the last one, the money market mutual fund. Remember, the difference between this and a money market account is that it is not insured. It doesn't have that FDIC insurance component. It is, in my mind, a temporary holding spot for your money until it's invested. So I'm just going to go to Vanguard right here. And when you're in Vanguard, all we're looking for is general information. So I'm just going to go, I don't want to sign in. So I want to look at, I think I'm going to have to full screen this to see it. Here we go. Vanguard, under investing, I'm just going to look at their mutual funds, Vanguard's mutual funds. And then I'm going to browse Vanguard funds by asset class. And the way these are going to be sorted is in risk order. So here are my money market funds. Taxable money market funds, Vanguard has 2. Their 1-year rate of return is 1.18 or 1.35, somewhere in there. This is, again, not insured, but it's a way to hold your money in your investment account until you make investments into bonds, stocks, mutual funds, ETFs, etc. So let's go ahead and put down 1.35% in our table. And that's about $13.50 a year. So now the question, why did we even do this? So the real question is, where should you have your emergency fund? Should it be in a savings, a money market account, a CD, any government product, or a money market mutual fund? And let's look at liquidity. Liquidity is how easy you can get to your money. So in a savings account, liquidity is high. Money market account, also high. CD, no, it's locked up, so liquidity is low. T-bill, you have to wait for a year. Can you take it out early? No, so that's going to be low. You probably could in a hardship. EE savings bonds, you have to wait a year. I savings bonds, you have to wait a year. Money market mutual fund, you can take out at any time, so this would be high. So I want you to think about this. Again, these virtual bank accounts are not as high as an iSavings bond, but it's a great way to hold your money on a monthly basis and get a nice interest rate boost over anything else. And again, these, if you want really safe place, again, if inflation is going up, an iSavings bond might make sense. But I'm going to introduce you to another investment type product called a TIP when we talk about bonds. So now you know these are safe places for your money, and I look forward to seeing your homework. Thanks.